I wanted to provide an introduction for new graduates on where to put your 401k contributions. Um, if you're a new graduate in nursing or engineering, you may not be very well aware of some of the investment choices you have. But even if you've studied finance, okay, it's likely that you studied academic topics. Those of you who have been to my site and viewed my videos here on YouTube know that we cover a lot of these academic topics of valuation, and they're really important. But once you graduate, you start thinking, what should I put my money into? We never talked about that in class. Basically, we did valuations and we drew graphs, but we never thought about where to put our money. All right, so there are two questions you want to address. Which investments should I choose? What percentage should I put into each investment? So, generally speaking, and you may have more choices, your corporation that you're working for is going to offer the following choice: stock of the company you work for, various stock mutual funds, and various bond funds. And they have to offer a range of these based on the Employee Retirement Income Security Act, which governs retirement plans. So they have to give you some choices. They can't say, look, the only choice you have is the stock in your company. So let's take a quick look at some of these. All right, and let's just make it really simple. For those of you who haven't studied any finance, stock represents ownership in a company. And what it does is it provides you some growth opportunities. If the stock does well, if the company does well, the stock price goes up and you make some money. And you've seen that with many companies over the years: Apple, Amazon, eBay, etc. Okay. Bonds, on the other hand, are a form of lending. So when you buy a bond, you're lending a company or the government money. And this is useful because it generates income. Usually the choice in investing is between growth and income. Okay? When you're saving for retirement, you're looking for growth. Okay? You're not even concerned about income for your retirement plan. Okay? Once you get closer to retirement, you'll be taking the money out, so income matters. But right now, you don't care about income. Okay? You really just want growth. If you invest in a bond fund or a money market fund, those are for income and for safety, and you don't need those in your 20s, not in your retirement fund. You may need them for other types of investments, for example, saving for a house. But in terms of your retirement, you don't need it. As you get older, you may start to add more bonds to your portfolio to reduce the volatility of your portfolio, so that if the stock market goes down a lot, the value of your portfolio won't go down as much because you hold 20 or 30% in the form of bonds. But right now, that doesn't matter when you're in your 20s or early 30s or even in your 40s for that matter. Okay, so what are your choices? We want to go with stocks. Should you pick the stock of the company you work for? Well, it's great if you happen to be working for Amazon or eBay. You'll wish you put all your money into Amazon, your retirement money into the company stock. But it could easily be Enron or WorldCom or some other company that either goes under because of competition or because of fraud. When you buy the stock of the company you have no diversification. Keep in mind that if the company does poorly, okay, and goes under, not only do you lose, much of your retirement money, you'll be out of a job. So it's really not a great idea to buy a lot of the stock of the company you work for. Now, you may get some stock from the company. If you get an employer match, which I'll talk about later, that's likely to come in the form of the company stock. And you may have bonuses and things like that that may come in the form of the company stock. But as far as choosing where to put the money you're taking out of your paycheck and putting into your retirement plan, I don't recommend that you put it into that. I think you should put it into a mutual fund. A mutual fund, for those of you who don't know, is really just a financial institution that collects money and then from a lot of different investors, and then goes out and buys a lot of different securities. So they may buy stocks or they may buy bonds. Here we're focusing on stocks. And so they're able to buy a lot of different stocks because they have money from a lot of different people. And you're also getting professional management. So you're getting diversification as well as professional management. Okay? If you buy the stock in your company, you're not getting any diversification. So when you choose the fund, you want to make sure that you care about expenses. Okay, you want to pick the funds that have the lowest expenses. So let me give you a couple of examples here. Vanguard, which is a large family of funds, has an S&P 500 fund. It tracks the S&P 500, and it has an expense ratio of 0.04%. So for a $10,000 investment growing at 5% per year, you'll pay about $51 over 10 years in fees. Not very much money. Fidelity Magellan, which is also a very well-known fund, has an expense ratio of 0.79%. So for that same $10,000 investment, you'll pay $976 in fees over 10 years. The difference between the two is that Fidelity Magellan is an actively managed fund. And it has higher expenses because they hire analysts to decide which stocks to put into the fund. The Vanguard 500 fund is what we call a passively managed fund. It just tracks an index. So it doesn't have all these other expenses of paying analysts as well as all the transactions costs of buying and selling and buying and selling. It simply buys what's in the S&P 500 index in the appropriate proportions, and doesn't keep buying and selling and trading. And so you don't have the analysts, you don't have all those trading fees. Really keeps the expenses low. Okay, and the reason you should care about this is, well, $10,000, you go $51, $976. Remember, at some point you're going to have a lot more money than that in your fund. So if you had $1 million in there, you'd pay Vanguard about $5,100 over 10 years. But you would pay Fidelity over $97,000 in fees over 10 years. So this is starting to look like real money. And so being able to pick a low-cost fund is a really important choice. Okay? The reason that you want to take a look at buying an index fund or a passively managed fund is that it's very hard to beat the market. Okay, those of you who've studied finance know this term, market efficiency, or the market is efficient. Okay, it's hard to beat the market because there are a lot of smart, hard-working analysts and fund managers out there. Okay, I mean, think about sports. Every team wants to win the Super Bowl or the World Series or whatever championship they have. It's very hard to do that. Okay, even, for example, the New England Patriots, which had an astonishing 20-year period with Bill Belichick and Tom Brady. They went to 9 Super Bowls and they won 6 of them over a 20-year period. They still, they went to less than half of the Super Bowls they could have, and they won less than a third of them they could have won. So as phenomenal as their record is, they're not winning every single year. Okay? And so in the case of the market, the S&P 500 index, on average, in most years, tends to be about 2/3 of the mutual funds out there. Okay? And keep in mind that the 1/3 of funds that beat the market tend to be different from year to year. So it's very hard to identify a fund that's going to beat the market year after year after year, making those extra expenses worth it. Okay? And even if they do beat the market on a before expense basis, once you add up expenses, that may eat up some or all of the extra return. So, it's easier just to cut out the middleman and just go with the index. So, this is my advice. In your 20s and 30s, your best bet for your 401k or other retirement plan like an IRA is 100% in the low-cost stock index fund like an S&P 500 fund. Okay, or better yet, you may have a choice of a total stock market index fund. If you buy the S&P 500 fund, those are very large companies. The total stock market index fund is going to include much smaller companies as well. They're riskier, but they also have much more potential. Remember, Amazon was once a small company, as was Microsoft and eBay, okay, and they grew into behemoths. And we want to note that in general, you can't withdraw from a retirement plan until you're 59 and a half. So you've got a very long time horizon. So if the market goes down, so what? Okay. In fact, that's actually good for you because you're contributing through payroll deductions. And if the market goes down, they're just buying you more shares. Plus, when you're 20 or 25 years old or 30 years old, you probably don't have that much money in the market anyhow. So, if you only have $10,000 in there and it dips 20%, you've lost $2,000 on paper. That's not a huge deal. You have $1 million in there, it dips 20%, lost $200,000. That's a much bigger deal. But at this age, it doesn't matter. You can wait it out. So let me show you this chart here. So I got it off the internet, and I drew a trend line in. So there's nothing magical. I didn't use an econometric model to draw the trend line. I just want to show you that the market tends to rise. So I tried to pick around a 40-year period, a little bit more than that, and it's going up, right? And there have been ups and downs, okay? Down here in the early 80s, we had a bear market, so the stocks were down, okay? Warren Buffett was very happy about this. He bought a lot of stocks very cheap, okay? He's famous for being a value investor. He tries to find stocks that are selling for less than he thinks they're worth. And they went up, right? And we've had ups and downs. So this is the risk you're taking, this blipping up and down. And then we had this great bull market run where, stocks rose quite a bit and then came crashing down. This is the internet bubble, okay? When the internet stocks crashed. Yeah, it came down, okay? Around the late 1990s, okay, and early 2000. But then eventually it started to go back up, and then we had this big dip from the Great Recession, 2007 to 2009, but it's come back up. Okay, right now we're going through a dip here in May of 2022, but you know what? At some point, I can't tell you if it's going to keep going down or it's going to start blipping back up shortly. Okay, but over the long haul, over 20 or 30 years, it's likely to be much higher and way up here someplace. So, you can wait it out. It's really no big deal. This is the best thing you should do. All right, so let me offer a few general investment rules for you. Start saving early. If you save $2,000 a year for 30 years and you earn 10% per year, you'll have around $329,000. If you start 10 years earlier, so if you start at 22 rather than 32, you'll have more than $885,000. So starting earlier makes a big difference. And remember, you're hopefully going to be saving a lot more than $2,000 a year. Okay, when you first start working, this may be what you save, but after you start making more money, you'll be saving quite a bit more, hopefully. Okay. Number two, take advantage of any employer match you might get. A lot of employers match contributions. For example, 50 cents for every dollar you contribute up to 5% of your earnings. So you really want to try and make every effort to put that 5% in, because essentially you're getting a 50% return for simply, putting money into your retirement plan. Okay? And that's probably going to be in the form of the company stock. So that's why, again, I don't recommend that you buy the stock with your own money. You will have some of your company stock, and hopefully the company does well, and that will enhance your return. Okay? Work to max out your contributions to the legal limit. Okay, so keep increasing your contributions until you get to the legal maximum. Okay, right now in 2022 it's $20,500. If you're under 50, it's $27,000. If you're over 50, okay, those are quite large numbers. Or the $20,500 is quite large when you're 20 some years old. You've got student loans, etc. So whatever you can put in, start now, and if you get a pay raise of 3%, try and put 1 or 2% of that in, okay, before you even see the paycheck. You'll never even see your check going down, okay, you'll be putting a little more in. If you get a promotion and you're making 20% more, try and put a good percentage of that in and keep doing it until you get to the maximum. Okay, you'll be a lot happier once you start getting to 50 years old. It's hard to think about being 50 when you're 22 years old, but someday you're going to get there. And you start looking, you say, I got a lot of money in here, and if you don't like your job, you can feel much more comfortable about the thought of retiring. Okay, and the final rule is avoid market timing, which means don't try and guess the peak of the market so that you can say, well, let me sell that because we're at the peak and I'm going to buy back in when it's at the bottom. If you could do that, you saw that graph I had before, that would be really good. That would enhance your returns. But it's really hard to do. Just forget about your contributions. John Bogle, who was the founder of the Vanguard group of investment companies and sort of the father of these index mutual funds, would tell investors, don't even open your 401k statement when it comes in the mail. It usually comes quarterly. Just, throw it in a pile somewhere. Don't open it. And then once you're 65 or once you're getting ready to retire, open your statement. He would say, make sure you're sitting down, because when you open it up, you'll just be shocked at how much money you have in there. If you've just been contributing, every pay period and you've gotten to the maximum that you can contribute, there'll be a lot of money, 30 or 40 years from now. So I hope that's helpful, and I hope that gets you started on your retirement savings rather than, sitting around finding it so daunting that you don't even enroll in the plan. So good luck.